Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at one of the best-selling tracker funds on the AJ Bell Youinvest platform at the moment, namely Vanguard FTSE Developed Europe ex-UK ETF. Now, sorry, that's a bit of a mouthful, but this tracker product is an ETF, or exchange traded fund. It's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. In this case, the tracker's following an index which covers Europe's stock markets, excluding the UK. The benchmark consists of around 400 large and mid-cap companies with an aggregate market valuation of around £4 trillion. The two-thirds of the assets are held in firms quoted within the Eurozone, the other third without the currency bloc. The three biggest holdings are all Swiss, actually: food giant Nestlé and pharmaceuticals leaders Novartis and Roche, while other key positions include German electrical engineer Siemens, French oil major Total, and Belgium-listed brewer Anheuser-Busch InBev. This first graphic then shows the sector weightings. Financial services, healthcare, and industrials predominate, while real estate, utilities, and energy have a relatively limited presence. The majority of investors looking at this tracker will probably be seeking capital gains, although the ETF does offer a 12-month yield of around 2.7%, and dividends are paid quarterly. As a final point, do note that Vanguard FTSE Developed Europe ex-UK is one of the 16 top trackers which form the AJ Bell Investment Guidance Service. This instrument does not feature in the cautious or balanced portfolios, but has a 15% weighting in the adventurous one. So those are the mechanics. The question to address is why your fellow investors are buying this tracker in such numbers right now. And I think there are three possible reasons. First, Europe is still a bit of a contrarian pick. As we can see from this chart here, the underlying index hasn't really done much for the last 12 months, weighed down by concerns over the existential threat posed by the UK's referendum vote, the political threat posed by key elections coming up in Italy, Germany, France and the Netherlands, and persistent worries over sluggish growth and inflation. Second, this period of, frankly, duff performance does mean that Europe is cheap relative to its international peers. So anyone who does think things may be about to get better over the channel may think there's a bit of a bargain to be had. As we can see from the graphic behind me, according to data from Bloomberg, the Eurozone, as benchmarked by the Stoxx Europe 600, comes at a valuation discount to the US and UK and offers a higher yield than America, at least according to analyst consensus forecasts for 2017. Third, it's just possible the gloom's overdone. Regular viewers may remember this video's predilection for Belgium's Courbe Synthétique as a guide to Europe's economic and financial market prospects. Quite why an industrial sentiment indicator that uses the views of 6,000 Belgian industrialists provides such a keen insight is itself a matter for debate another time. And anyway, the past is no guarantee for the future either, but the latest survey showed improvement, and generally where the Courbe has gone in the past, European stocks have tended to follow, as per this final graphic. Now that's not to say Vanguard FTSE Developed Europe ex-UK ETF comes without risk. It sits within the Guided Investment Services Adventurous portfolio with good reason, as this final chart shows the tracker's price development since it began trading in autumn 2014. There is clear scope for further political and economic uncertainty in the coming months, especially as those key elections take place and the UK inches towards invoking Article 50. So thank you for watching, and I look forward to seeing you next time.